Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Today, we wrap up results season with a look at the biggest company of them all, Nvidia, which reported figures overnight amid the usual frenzy of interest. Arthur Sants will join us from New York shortly to discuss whether the chip designer's results justify the faith investors are still putting in the AI boom. Alex Newman will also give his thoughts, and we will also touch on the US government's new equity stake in Intel. Before that, we will talk about our big read of the week, all about nuclear power, enjoying something of a renaissance at the moment thanks to the energy transition and, perhaps more significantly, tech giants' need to power their AI ambitions. Alex Hamer will discuss demand, supply, whether this boom will prove sustainable, as well as looking at uranium investments and their prospects too. To wrap up, we power down with a company that's been withering rather than booming in recent years. Boohoo, or Debenhams Group as it now likes to be known. Mark Robinson and Alex Newman will discuss the delayed full-year figures and ask if there's any chance of a revival. Alex Hamer, though, we're going to begin, as we said, with the big read of the week, nuclear power. Been in the news a lot recently for a number of reasons. But why don't we start by talking about the big picture about why it's revived? There's, of course, the energy transition, as I just said, but also, particularly in the US, big tech is getting involved, and they are, in some cases, directly responsible for a revival of nuclear power. So can we just set the scene a little bit first?
I think the starting point is we need a lot more electricity, really. And those forecasts have been around for a number of years based on the energy transition. So people driving electric cars around, greater electricity use within the home, within businesses and industry. And that's been vastly accelerated through, once again, in the US, the electricity needs of these AI data centers. So because of the much greater computing power needed to have a little thing tell you that you're running late for a meeting or you're depressed or whatever. They're
among its many attributes.
Yeah. What the tech giants need is really reliable sources of electricity that they're happy to pay for it. I mean, that's the thing. I mean, when we've talked about energy transition investments, it's often been couched in when will these companies get returns from selling these electricity sources. So, you look at the oil giants going into renewables, but this is a completely different conversation where they just need that baseload electricity and will pay for it and have the balance sheets to do that. So through that, we've seen the restart of one of the reactors at 3 Mile Island, which famously had a meltdown a few decades ago. And then it's not the one that had a meltdown, but there's another one that was running up until about 2018 that they're restarting. There's also a lot of interest in these small modular reactors, which I'll touch on a bit more in a moment. But you've got all these nuclear plants in the US that have been running for 40, 50 years, and that was seen to be the end of their safe lives, really. But those are being extended now, so we might see plants running for 80 years or so.
Yeah, plants reopening, life extensions are one thing. In the UK, the conversation is much more focused on the longer term because it's less of a need for tech giants wanting to restart things, more about a case of how we're going to provide more electricity in future. Clearly with the Sizewell plant we spoke about on the show a few weeks ago, and the good deal Centrica got there and they're helping fund that, which we might come to. Can we expect more of that kind of thing in the UK, the US as well? Clearly that's not going to meet any tech demands in the next few decades, given how long it takes to bring things online. But do we expect to see more nuclear plants in general, given this groundswell of interest?
Yes and no. I mean, start with the no. I think after the experience of Sizewell, after the experience of Hinkley Point C, which is the one where EDF is really struggling to get it done within any shout of even upgraded cost estimates. And Sizewell will be a test of whether they can just repeat that. And with a few modifications, I think there's about 80% crossover between the plants. Whether they can do that within the I think £39 billion budget, but there won't be those huge reactors being built, specifically in the UK, on those same lines, because firstly, EDF has stopped taking orders for those plants. They're extremely difficult to build. They're so highly regulated, which is, for good reasons, but they're so highly regulated that the design is just it's backup on backup on backup on backup. And then the yes part of the answer is that people do want nuclear energy, and where it's coming from is, there are life extensions in the UK. There's EDF Centrica owned plants that they're squeezing another few years out of that were supposed to have closed already. But what everyone's looking forward to now is Rolls-Royce's small modular reactor model, and a regular sized nuclear power plant, as we've known them for decades, is about a gigawatt in capacity. And Rolls's model is about 420 megawatts, so just under half that scale. And then on the small modular reactor, or SMR, scale, that's actually quite large. So the idea is now that instead of these absolutely monstrous nuclear power plants, you can have something that's slightly smaller and a lot more repeatable that you can put in place. There's still a lot of regulatory questions, and the government has said that it's really backing this and has funded Rolls' development of its SMR. And the technology isn't really in question. It's effectively a smaller version of a bigger nuclear plant. But what is up for grabs now is who can get through these regulatory hurdles and prove their model quickly. And Rolls-Royce is in a really good position for that because of the government backing, and also because of its experience and I guess its confidence in its model.
Yeah, SMRs, they are something we've been talking about, it feels like, for a long time now, albeit we are perhaps getting closer to a point where they, I'm not going to say take off, because we don't want that to happen. In the US, though, as you mentioned in the piece, things are moving with SMRs as well, and in terms of certainly connection times, and maybe in terms of some of the companies that whose shares have already been bid up in anticipation of this expansion, things are maybe slightly further along.
And I think what we've seen there is both the investment interest into these companies that have their own model that aren't something like a Rolls-Royce that's been doing this kind of thing for a long time. I think there's something like 120 different SMR model proposals from companies in the US, and you wouldn't say that more than a handful of those will actually get through. But what's happening now is the White House has set a challenge for 11 companies that have been picked to take part. Their job now is to try and get something into development so that they can turn it on within 11 months, which is an insane timeline for this thing. But what it has given them is permission to do that, when previously that might have taken years, and that would leap the US ahead of Rolls-Royce in terms of development. If I was a utility or a government, I'd probably go for a Rolls-Royce over a pre-revenue startup that might have some very smart engineers, but it's basically something they've sat around at a table and come up with, as opposed to a broader industrial company. But that's something we'll see. The other, I guess, context worth mentioning is that China's already building its own SMR. Russia's state nuclear agency, Rosatom, that's already put these into development. I think we're focusing on the West here because that's what we can invest in, and it's what we'll see a bit more with our own eyes. But like I said before, this is just a smaller version of existing technology for the most part. So, China can build a full-size nuclear reactor for a sixth of the price of the reactors we've seen in Europe recently. you assume that to carry over a little bit with SMRs. And given they've already got the repeatability down, that they're already in a pretty good spot.
Well, the demand side seems fairly assured. That's talking about the build out, which also is starting to happen. But what about the fuel sources, uranium, things like that? The uranium market has also done very well this year on the back of some of these trends. What is the supply picture there looking like? What are the forecasts looking like, first of all?
I think just I keep using the word context, but it's just me trying to put in more facts and figures for listeners. But you take, for example, a coal power plant, and one of your main costs in running that is buying coal. Nuclear plants are different. I think uranium has 14,000 times the energy output per kilogram of coal. So it's something that you buy earlier on in the process. It's contracted. So the market is a little bit different to a usual spot market, and the cost base is a bit different to other types of power plants. But and that has contributed to a bit of malaise in the uranium mining sector. There's two major players. That's Cameco in Canada and Kazatomprom in Kazakhstan, and they've dominated the market for quite a while. And they've turned off mines because the price has been so low. And that's $20 a pound. It's about the low that we've seen in recent years. And because of this interest in nuclear and forecast increase in demand that's coming along, that has actually that got up to over $80 earlier this year. There was also a peak last year as well, early in the year. So that it almost shows the investment interest, and that's also come from a few vehicles where smart investors have raised cash and used that to buy yellowcake, and those vehicles have managed to buy up a lot of uranium to the point where it's material for the market. So if Sprott announces that it's raising new cash, the spot price of uranium will go up. So there's I mentioned that to show that there's a few different factors in this market. But investors that I spoke to for this piece, they're betting on the supply side, not keeping up with demand. This isn't so much a huge increase in demand from year to year because of the long lead times in the nuclear power sector. It's much more about, will a handful of mines around the world struggle to meet expectations? And uranium mining is quite tough. So that has actually been borne out.
You make some interesting points there, certainly about the way in which returns have diverged recently as well. I mean, I was thinking that something like yellowcake had done pretty well over the last year, but it hasn't actually, partly for those reasons. Cameco, the big US miner, has had a pretty good time, but maybe that's partly because all things nuclear uranium in the US are doing better, albeit that Sprott Trust we mentioned has also had slightly more mixed fortune. So that does show, of course, that the need to be particular and the need to find a particular investment is always important. The rising tide does not lift all boats, as ever. So you're talking about people you've spoken to in the market sort of betting on that side of things, or some of those aspects of it. What do we see as the interesting opportunities in this context, given the varying valuations, prices, and given all the backdrop we've just spoken about?
Where to invest now is an interesting question, because there's been such a run up in these companies that have put forward SMR models. Some company like Constellation, which is reopening the 3 Mile plant, doing well this year. It looks fairly toppy, to be honest. The investors I spoke to had taken this view, and for example, Copernic is a US fund. They're sitting on Paladin Energy and Kazatomprom. I feel like our UK listers might have a little bit of hesitation on putting their money into Kazatomprom, which is state-owned in Kazakhstan. But the Copernic guys really backed its assets, potentially over the geopolitical considerations. Another one that came up also through GigaCounter, it's a UK investment trust. They've backed Paladin Energy, which is an Australian listed company, which has restarting a mine in Namibia called Langer Heinrich. They've had a lot of trouble with this, which means it's needed a fairly high uranium price to look interesting to the market. They're actually down about 20% this year. But I think the argument for a developer like that has had some issues is that there is some value there. So there are a few interesting options. I think a company like Oklo, which has gone from a $900 million US company to a $9 billion US company in the past year, probably wouldn't put my money into that at the moment. It still needs to prove its SMR model. So I think there's companies like that people should get a pretty clear read on. But given the movement in the sector, I think there's some interesting things on the mining side.
So it's time now to move on to our next segment, and we are discussing one of the companies at the forefront of the AI boom, if not the company. That is, of course, Nvidia. Overnight, as we record, so Wednesday evening, it put out latest figures, hotly anticipated as ever. The response this time was perhaps a little bit more lukewarm than it has been in recent quarters. Of course, partly a victim of its own success and partly a victim of market expectations. But Arthur, you looked at the results that came out last night. What did you make of the figures overall to begin with?
Hi. Yeah, so the market was pretty lukewarm about the results. I think the main story this time around was around their Chinese business, which has been knocked around by government intervention during the year. So the data center compute revenues, they split their data center revenue between compute and networking. Compute is like the chips that do the thinking, and networking are the cables that connect the chips to each other. And the data center compute revenue was down 1% quarter on quarter because they didn't get any revenue from China because of the restrictions. Basically, they built these H20 chips, which were lower powered chips as a way to get around the original restrictions, which they were going to sell into China. But then they weren't even able to sell any of those into China last quarter. The Trump administration then has decided that they are now allowed to sell the chips into China, but they have to give any of those chip sales, 15% of that revenue has to be paid to the US government. And then on top of that, the Chinese now don't really want their companies buying Nvidia chips because they think it's a security risk. They also want their own domestic companies to improve and have the same capabilities that Nvidia does, which means that Nvidia, for its third quarter guidance, said it's not anticipating, it's in that guidance, it's not including any revenue from China. So that's basically the main concern from these results, is that what's going to happen with its Chinese business. And now, even though the Trump administration has said that they can start selling these lower powered chips into China again, will the Chinese even want them? Outside of that, though, every other part of the business continues to grow rapidly. Like year-on-year revenue growth was up over 50%. And other than data center compute, all the other parts of the business, gaming, networking, automotive, etc., all continue to grow at pace. So it's just sort of the China thing that was the issue in these results.
Yeah, we'll come back to some of those broader expectations and how Nvidia is doing at a base level in a moment. Let's talk about China first of all, because there has been a lot of focus there overnight. There are two sides to it, as you say. First of all, whether the US is going to allow them to sell H20 chips to China. Secondly, whether China actually wants them now. There have been some comments by Howard Lutnick, I know, which Beijing seemed quite annoyed about, and that may have further dissuaded them, judging by reports we're getting out of China, now asking its companies to try and avoid these chips. I mean, it's very hard for us to obviously read the runes of what's going on and the involvement that Donald Trump and the US administration will have in these sales and the 15% cut they want. But just maybe from China's point of view, do we think they want, despite what they're saying, still need these chips and the more advanced Blackwell chips as well, if that's something Nvidia could sell? Or do we think they would be able to make their own chips sufficiently quickly now and make some alternatives. We had the whole DeepSeek thing earlier this year, which really showed the kind of capabilities that can come out of China. Clearly, a huge nation with a huge capacity for technological prowess. Do we have any sense of whether the whole China sales thing for Nvidia will be a bust now? Do we think China still needs them to an extent as much as they need China?
I was thinking about this before, and I think maybe if you go back to 2019, there was some evidence that China has the capacity to sort of ramp up its semiconductor potential when it's like forced to. Because in 2019, that was when the original Trump administration put the sanctions on Huawei, which crippled Huawei for a while and was part of the reason why Apple then managed to get increased loads of its iPhone sales into China, because Huawei was one of its main customers, and the US government sort of pushed its business back loads of years because of all these restrictions, because they were buying US chips to put in their phones. And then fast forward to last year, and Huawei released a new phone with a 7 nanometer chip in that had been made in China that was like on par with the chips used in the iPhone. And this Huawei phone is now like eating into Apple's market share in China. So that was like a 5-year period, and by all reports, that phone is like as good as the iPhone, and they managed to catch up in smartphone because they had to. And a similar thing, I don't see why, when put under enough pressure, China couldn't find a way to catch up with the US, I guess, given enough time. The difference in the short term is, they had the DeepSeek model that was released at the beginning of the year, which reportedly didn't use any Nvidia chips. That was, some of the US companies said, well, maybe they've been sneaking Nvidia chips in. The thing about it is the Nvidia chips, like the Blackwell, the newest series, Nvidia says they're 10 times more efficient at inferencing than the previous generation, which if you're a company that wants to make a lot of money, is obviously really useful, because currently these AI companies don't make any profit because it's so expensive. So if you're a US company looking to make profit, having the most like cutting edge Nvidia chips to operate on is essential, because they're the most efficient. But if you're China and you maybe are being state subsidized and you don't care as much about making a profit, you can just get more and more chips of the sort of less efficient chips and put them towards whatever sort of AI task you're trying to achieve. So if you're willing to lose a lot of money, which maybe the Chinese are if it's a state subsidized program, it's not as big a deal that they get the most cutting edge of the Nvidia chips. But if you're a US company and you need to make money for your shareholders, you want to be right at you want to be buying Nvidia's most up to date.
Indeed. Well, we will talk about some of the other aspects of the business in a moment. I mean, the fact they haven't included this China revenue in the forecast has kind of de-risked it, you might say, or they might be hoping that's the case, but there may be other risks there, which I think Alex Newman will talk about momentarily. But before we move on to that, let's just talk about your view on the valuation of the company. I mean, we've spoken about this various times over the years and written about it quite a bit as well. If you look at the company, you look at certain fairly standard valuation metrics, it doesn't look that expensive. Equally, while revenue is still growing very quickly, the sequential rate of growth has been falling in recent quarters. There are expectations to keep up with. What's your take on the current valuation of Nvidia, given all this?
Yeah, so I've kind of, in a few times in the almost, I think once a year for the last 3 years, have written that Nvidia actually isn't that expensive. I think I read it in 22, 23, and then I read it again at the beginning of this year when it was trading on a forward P around 25. So it's now up a bit, but even it's 2027, because its shares have gone up a lot in the last few months, but even its 2027 P ratio, I just checked, is like 29, it was just under 30, which isn't an particularly costly valuation for a company with over 50% operating margins, is growing 50% year on year. So the valuation and its PEG ratio, which is like when it's adjusted for growth, is only 1, which isn't that expensive at all. So on lots of sort of those valuation metrics, it just doesn't look that steep, given it's got a monopoly on the like, most in-demand product in the world. But as you said, yeah, there has been slowing growth, which I think the issue is not that the valuation is crazy, but that maybe there's sort of the bubble is more on the sort of demand side, and that all these companies have bought all of these chips, and will they continue to invest at this pace? And I read Alex Newman article earlier this week explaining that the concentration, so there's only like the 4 companies make up over half of its revenue, so it's extremely reliant on the investment decisions of only a few businesses, and probably given only a few people. So if they change their mind, then revenue growth would slow. I still think it's probably like no one else has really been able to catch up. And I thought the infrastructure growth was interesting. Infrastructure revenue grew in data centers grew almost doubled from this time last year, which shows that Nvidia basically offers like the whole service. Like it can sell you the chips and the way to connect the chips with each other, and it has the software that you can code on. So it's kind of got the whole stack covered. So it seems even harder for other companies to compete with it. One potential red flag in the earnings that I don't think many people have talked about is that its cash pile is also growing rapidly, which we'll see. Obviously, it sounds like a good thing if you've got loads of cash on your balance sheet, but also if you've got loads of your cash on your balance sheet, it might indicate that you haven't really got many other avenues to spend your money. And that could be a sign that we're sort of reaching the top of the bubble. But as we say, we'll see. But I don't think the valuation looks crazy on lots of metrics.
Yeah. Well, you mentioned Alex's article, and Alex is, of course, here and wants to talk, I think, a little bit about that customer concentration piece, about which you do have some concerns, Alex. And there's also there's also a big elephant in the room as well to talk about, which is the practical uses of AI and the existence or non-existence thereof. So why don't we start with customer concentration and your thoughts on that aspect to begin with?
Yeah, no, certainly. Yeah, I'll briefly kind of sketch out what I wrote in the piece. So, I mean, the focus on China this week was probably understandable because it was an unknown. But the lack of focus on customer concentration, I do think is quite a surprise to me. None of the analysts on the call, on the call with Jensen Huang after the kind of condensed release came out last night, that came out last night, really touched on this. He kind of placated the issue, the question anyway, because it will be on some investors' minds. You know, he said he sees no sign that the big spenders, these hyperscalers, are about to slow down this decade. And he talks about growing into a $600 billion capex budget for their biggest customers. So, I mean, they could still conceivably double their sales on that basis in the next 18 months, 2 years. But, you know, evidently as well, based on these numbers, I don't think, you know, you'd be brave to bet against the momentum given, you know, they're guiding for 73% gross margins and another fifth sort of growth in sales just sequentially in the next quarter. Anyway, so that's that. So it's not about to run out of steam, clearly. But if you look at the 10Q filing, which I think came out later last night, that's when they break down their anonymized details on their biggest customers. So that's always going to be a question investors have, any company. If sales for any one customer are above 10%, that gets into the you know, questions about dependency, concentration risk. And looking at the 10Q, you get this. I'll just read it out briefly. They say customer A represented 23% of total revenue in the quarter, and a second direct customer represented 16%. So, okay, already there we've got 39% of total revenues just between two customers. If I'm reading this correctly, and I think this is the only way you can read it, then they detail 4 other direct customers who represent a cumulative 46%. So I think reading that, unless I've got something, I've misread it completely, but I've read it several times. I make that 85% of revenue split across 6 customers in the quarter, and across the half, something like 69%. That concentration has been growing steadily in the last couple of years, unsurprisingly, because it's the big hyperscalers, the Microsofts, Amazons, Metas, and Alphabets who have been buying so much of their products. I think Oracle as well have got a deal to buy a lot of GPUs. So, like, they're not running out of steam, as the caveat qualification above that I made. But this is getting incredibly concentrated in just a handful of customers. And when we get to the point at which one of them pauses or slows down their demand, that could be the real sort of bubble, if not bursting, then starting to look very fragile in this story, because Nvidia is essentially a function of the rest of the Mag 7's capex spending now, and that is growing, but can it grow forever? I don't think it can.
And the other point we should touch on briefly, even though it is in some ways the most significant point of all, is about the practical use, the end markets for AI, which has been of slightly more concern than people are paying slightly more attention to it than they have been for some time, following the report produced by MIT the other week, which I think suggested that about 95% of companies' AI projects so far have no real return as it stands. I mean, this is something we've discussed again on the show and in print for a long time now, but we've been talking, I think, Arthur, you've been talking as well about increasingly we're getting to the point where companies need to show that kind of end result. So far, however, there hasn't been a huge amount of evidence that a lot of these projects are working. Alex, what's your kind of take on this whole subject, and as you put it, the need for a killer app, perhaps?
Yeah, I mean, that MIT report came out last week suggesting that 95% of attempts to apply AI models or building software on top of the models aren't generating a return on investment. This is the huge debate, like you said. Are these investments because it's a 5-year horizon at which point the hyperscalers can see where there is a break even for the AI startups or software developers, and we're just going to get this absolute explosion, orders of magnitude growth for the next 3 years, where you'll have revenue generating profitable enterprises developing, possibly. But OpenAI, I think it's public knowledge. Anthropic, they're losing money hand over fist just running their models. So there's going to have to be a serious repricing of this technology to the end user, and that end user is going to also have to find profitable uses for it. And it doesn't seem that either of those those questions are really being addressed, I suppose, by the market and investors, but also being answered by the technology itself. And you don't want to sort of say, okay, nothing's going to work with AI and it's forever going to be unprofitable, because I think it's too open and complicated a question to give a verdict on at this point. But there's little evidence for that, here as standing halfway through 2025, 3 and a bit years are we into this into this sort of enormous explosion in hope for the technology.
Indeed. I think, yeah, so if you take end of 2022 as the start, we are a good way in now, and we'll see what, well, we will all see if anything comes of it, but there's a lot riding on it very clearly. Arthur, I just want to return to you very quickly because we are short on time, just to talk about Intel as promised. The US taking a 10% stake in what would ordinarily seem to be a pretty big problem for Intel, because it's taking this stake for $8.9 billion, which has already been granted or promised via the CHIPS Act from 2022. There's going to be shareholder dilution as a result, but in this new world where it's important to be close to the capricious US president and to have political influence, there's a decent suggestion that a decent case to make that this may be a good thing for Intel. What's your view on it very quickly?
I'm skeptical. Intel has failed. It's very hard to make advanced chips for AI successfully at a low cost and at a high yield. And TSMC is really good at it and really good at doing it in Taiwan. TSMC's said that even for its fabs that it's built in Texas, in Arizona, that the costs are way higher to make the chips in Arizona than they are in Taiwan. And Intel's trying to do all this manufacturing in the US. Samsung has also built a factory in Texas and is basically struggling to get any orders. Intel's struggling to get any orders. And no matter how much the president is on your side, if you can't make the chips at a reasonable price, and also more importantly, at a decent yield. So the yield is what percent of chips a manufacturer will make that actually work. And Nvidia is probably not going to put in a big order if they then turns out that half the chips that they've ordered don't even work. So I'm not sure how much the president can improve Intel's chip making ability, no matter how many sort of calls he makes. But I was reading a UBS analyst note that said maybe it would be the president would somehow help Intel negotiate some deals with Nvidia and Broadcom. But I'm still skeptical that that will happen. But I guess we'll see. But yeah.
Indeed. Perhaps we won't have time to go into it now, but the other thing I thought, alternatively, you could see it as a bit of a put option, really protecting against the worst case scenario for Intel, insofar as the government will now be even more, and literally invested in making sure Intel doesn't fail, where that worst case scenario to have emerged. But yes, clearly there is going to be a lot of political toing and froing over the next few years, as there has been over the last few. And we'll see how Intel manages to come out the other side. We're going to wrap up now, though, with a look at a UK company, one that is not among the great and the good, or hasn't been for a long time now, and that is Boohoo, Debenhams Group. Mark, you looked at the delayed full-year figures for last year that have been released the other day. It's trying to turn itself around, as you would expect for a company that's been struggling. It's trying to emphasize the Debenhams aspect of the business and a new business model, which we'll come to. But what did you make of the overall figures, first of all?
Well, I guess I should confess at the outset, that I haven't really covered the sector in any real detail in the past. And so I was coming in from the point of view of a novice, really, which wasn't such a bad thing, given that there's this transition underway. What my outlook on the company itself, it's a little bit difficult because that transition is an ongoing process. But looking at the figures this time around, there was some progress in rejigging the business models, particularly in relation to their cost base. They reported cash profits of nearly £42 million, but it's quite easily to manipulate EBITDA figures as well. And so you were just wondering whether what element of their core costs are being left out of that equation too. When you look at the in-house measure they use, which is gross merchandise value, and again, I always get slightly suspicious when people tend to use these or favor these in-house metrics, but that just might say more about me than it does about the company. That was pretty good over the year. It crept up slightly to just over 1.14 billion. The Debenhams brand itself was probably the standout in terms of profit generation, and again with that in-house metric. Whereas at its youth brands and Karen Millen, they didn't perform nearly quite so well. It's the group's also actively pursuing a disposal of PLT through a sale process, because the board has kind of given up on it really and says that's the best way to accelerate progress and maximize shareholder returns as well. There was some sort of practical, as I mentioned before, there were some practical steps the board has taken which have had decent results, like a gross borrowing came down during the period by about 200 million. There was a refinancing too from an operational perspective. And, the full year financials themselves, they took a back seat to the attempts to transform into a capital light marketplace model. Now, what does it mean in entirety? It's not exactly what they're undergoing now is not exactly a repudiation of the fast fashion brand or the fast fashion retail model. But I think it's a tacit admission that this no longer works, and we're seeing this type of transformation replicated across the industry as a whole. Now, when you look at this the marketplace model, the obvious examples here are Amazon and eBay, the latter more of a niche provider itself, and also falls into line with this general push towards might be termed an omni-channel offering in retail. I wouldn't say that it smacks of desperation, but they'd run out of options really. The capital light. Effectively, they're going to have third-party retailers on the platform. That's the sort of standardized model there, and you can see the attractions there. But I just wonder, given the competition in that market as well, it's very difficult to get hopeful that their platform offers anything from a customer-facing perspective that's going to make any difference whatsoever.
Yeah, there's a lot of context here that we don't have time, unfortunately, to go into from the whole demise of the fast fashion side of things, the labour practices, which clearly were a big black mark for the company as well, and even the recent saber rattling, if you want to call it that, or agitation by Fraser's group to try and get on the board and remove the existing management team. The distribution model, the marketplace model, we should maybe explain that a little bit more, because it is quite interesting the way retail is going. It's not just Boohoo. What, as you say, they're trying to do is have a situation where third-party brands on the Debenhams platform provide all the inventory and the shipping, and Boohoo is effectively just the hub, or Debenhams is the hub for that. It's going quite well so far in terms of sales growth there, but it's still a very small part of the business. And you think of companies like Next and M&S are doing this themselves too, so clearly two big and pretty successful competitors there. I just want to bring you in again, Alex, to talk about the figures themselves, because we talked about the adjusted EBITDA, and it is extremely adjusted in this case.
Yeah, so there's a few comments there from the the still relatively new CEO about how pleased they were to report this 42 million adjusted EBITDA. A comment also that they're pleased that all their brands are now trading profitably in terms of adjusted EBITDA. So in a way, this is the benchmark that investors are asked to focus on. And no wonder, given this like £4 million of equity, at least at the end of the trading period in the business. Really hard business to value. At least tax isn't an issue if you're looking at all those items under the line, because this is a loss-making enterprise. Net debt, I think, dropped in the period, though, as Mark said, they've got this new facility post-period, so a little hard to say what interest is going to be, but between 10 and 20 million pounds. Analysts have got depreciation and amortization at around 70 million pounds. Again, that's a bit of a finger in the air figure. And then we've got the unknowable exceptions, further write-downs, losses on disposal, whatever it might be, other gremlins they might be yet to find. I mean, we're already heavily into a statutory loss there. So, yes, pleased at some sort of level that they're profitable, but are they profitable? Is this a profitable business? It's really quite hard to say. And when you're being asked as an investor, I suppose, to factor in when the turnaround is, given it's so hard to value any individual asset within the company or division on a standalone basis, that's it's a huge challenge. I don't think it's easy or possible, really, from these accounts to make a good call on what profit is going to look like, this year, or losses this year, let alone in 2027.
Indeed. Well, we still have them on a sell, so that's our judgment there. But for today, we have run out of time. So thank you very much, Alex. Thank you to Mark, to Arthur, to Alex Hamer, and to our producer, Maddie Apthorpe. We'll be back next week with another Companies and Markets show.